What if everything you've been told about the global economy recovering is wrong? What if 2026 isn't the year stability returns, but the year the real consequences finally surface? Markets are rising in some places. Inflation appears calmer on the surface. Governments are celebrating soft landings. Central banks are signaling confidence. Yet beneath these headlines, something doesn't add up. Debt levels are higher than at any point in modern history. Interest costs are quietly exploding. Households are stretched thinner than ever. And global trade, the engine of growth, is fracturing in slow motion. So here's the mystery. If the economy is supposedly stabilizing, why do so many warning signals look worse than before the crisis began? To understand what 2026 may bring, we can't just look forward. We must trace how we got here step by step through decisions made years ago that are only now revealing their true cost. Setting the stage, the system behind the scenes, 1:10 to 4 o'clock. Modern economies run on three invisible pillars: credit, confidence, and coordination. Credit fuels growth. Confidence keeps money moving. Coordination between governments, central banks, corporations, and consumers keeps the system from tearing itself apart. For decades, this system expanded smoothly. Whenever trouble appeared, central banks stepped in, rates were cut. Money was printed, markets were reassured, growth resumed. This worked until it didn't. After the 2008 financial crisis, the world entered a new era. Interest rates fell near zero and stayed there for years. Debt became cheap. Governments borrowed more. Corporations borrowed aggressively. Consumers followed. Then came the pandemic shock. To prevent collapse, policymakers injected unprecedented stimulus. Trillions were created almost overnight. It worked temporarily. Economies reopened. Demand surged. But the system was changed forever. By 2022 and 2023, inflation erupted. Central banks were forced into the fastest rate hikes in decades. The cheap money era ended abruptly. Now, as we move toward 2026, we are living with the consequences of a system addicted to low rates, suddenly forced into withdrawal. Origins: the seeds of the 2026 economy, 4 o'clock to 7:30. The origins of the 2026 outlook trace back long before today's headlines. For years, growth was artificially smoothed. Recessions were softened. Asset prices were protected. This created a dangerous belief that risk had been eliminated. Debt exploded quietly. Governments rolled over old obligations with new borrowing. Companies replaced innovation with leverage. Households stretched budgets, assuming tomorrow would always be better. When inflation surged, central banks reacted late but aggressively. Rates rose faster than most economic models predicted. This changed everything. Because debt doesn't disappear when rates rise, it becomes heavier. By 2024 and 2025, interest payments, not spending on services or development, began consuming larger portions of national budgets. Businesses refinanced at higher costs. Real estate markets slowed, hiring softened. These pressures don't hit all at once, they compound. And that compounding pressure is what shapes 2026. The rise, the illusion of stability, 7:30 to 11 o'clock. By late 2025, many analysts began celebrating resilience. Inflation was lower than its peak. Employment remained strong in some regions. Stock markets recovered. Headlines spoke of normalization, but this is where cause and effect matters. Lower inflation didn't come from productivity miracles, it came from slower demand. Strong employment masked rising underemployment and weaker wage growth. Market recoveries were driven by a narrow group of companies, not broad economic health. This pattern has appeared before. In the late 1990s, before the 2008 crash, before multiple emerging market crises, stability at the surface, while stress builds underneath. By the time the data clearly reflects the damage, the turning point has already passed. The breaking point, way 2026, is different, 11 o'clock to 16 o'clock. Here's what makes 2026 unique and dangerous. Unlike past cycles, policymakers are constrained. Interest rates cannot easily return to zero without reigniting inflation. Governments already carry record debt loads. Global coordination is weaker than at any time in decades. At the same time, several pressure points converge. Debt refinancing walls for governments and corporations. Aging populations reducing labor force growth, fragmented trade systems raising costs. Technological disruption eliminating jobs faster than new ones appear. These forces don't cause sudden collapse. They cause slow fractures. Growth slows unevenly. Some countries stagnate while others struggle. Currency volatility rises. Capital becomes more selective. This is how economic stress spreads, not with explosions, but with erosion. Fallout. Who feels it first, 16 o'clock to 1930. The fallout of these pressures doesn't hit everyone equally. Households feel it through persistent cost of living stress, even when inflation numbers look calm. Small businesses struggle with financing. Young workers face delayed milestones, home ownership, savings, stability. Emerging markets experience capital outflows as investors seek safety. Meanwhile, wealth concentrates further. Those with assets adapt. Those without buffers fall behind. This divergence fuels social tension, political polarization, and policy uncertainty, all of which feed back into economic risk. This is not theoretical. History shows this pattern repeating whenever debt cycles unwind. Failed fixes. Old solutions may not work. 1930 to 2230. In past crises, governments had room to maneuver. They could slash rates. They could borrow cheaply. They could stimulate aggressively. In 2026, those tools are blunt. More debt risks credibility. Lower rates risk inflation resurgence. Stimulus risks currency pressure. This doesn't mean collapse is inevitable, but it means there is no painless exit. Adjustments must happen somewhere in growth, consumption, asset prices, or expectations. And historically, when societies delay adjustment, the eventual correction becomes harsher. Modern parallels. The pattern repeats, 2230 to 25 minutes and 30 seconds. The most unsettling part of the 2026 outlook isn't the data, it's the familiarity. We've seen this movie before: late optimism, narrow growth, rising debt service. Policy constraints, gradual slowdown masked as resilience. The names change, the numbers scale up, but the structure repeats. The question is not whether challenges arrive, but how prepared individuals and institutions are when they do. Final takeaways: what 2026 really means: 25 minutes and 30 seconds to 28 minutes and 30 seconds. So what should we take away from all this? First, 2026 is unlikely to be a year of dramatic collapse, but it is a year of reckoning. The consequences of past decisions become unavoidable. Second, headline stability does not equal system health. Pay attention to debt, productivity, and real income, not just markets. Third, periods like this reward adaptability, caution, and long-term thinking, not blind optimism or fear. The open question isn't whether the economy survives, it will. The question is who adapts, who falls behind, and who learns from history instead of repeating it. Ending, warning and call to action: 28 minutes and 30 seconds to 30 minutes and 0 seconds. Every major economic shift looks obvious in hindsight and invisible in real time. 2026 may be remembered as the year the world finally accepted that the old rules no longer apply. Or it may be remembered as another missed warning. That choice is still being made by policymakers, businesses, and individuals every single day. If you want to understand the forces shaping your financial future beyond headlines and hype, subscribe, like, and stay curious. Because in an economy built on confidence, understanding the system is the ultimate advantage.